Hello and welcome to the Wealth Doc podcast with your host, Mike Heckman. I'm Wendy McConnell. Hi, Mike. How are you?
Hey, doing fantastic. Great to be here. How are you, Wendy?
I'm good. And I'm happy to be back. Now, we have a guest, right?
Yeah, we have a guest. Glad to have our Chief Investment Officer, Rick Wedell, joining us remotely from, I think you're in Birmingham today, aren't you, Rick?
That is correct. You have found me on a day when I am in Birmingham. So yes, coming to you from lovely Birmingham, Alabama.
Oh, fantastic.
Always good to have a guest here. So welcome and thank you for joining us today, Rick.
Well, Wendy, thank you so much. And Mike, thank you so much for having me. I'm always happy to do these types of things. And it's always an honor, when I'm asked. So really appreciate it.
Yeah, well, awesome then. Just because we have a limited amount of time, let's kind of get to it. So, Rick, you've met some of our clients in some of the dinners events that we've hosted. And the last time you were in town, I thought you did a real good job just kind of explaining a little bit about as far as like what you do for Sobel Point and RFG and kind of like what your role was in there. And I was wondering if you could do a good job just kind of restating that to start off and reintroduce you to any of our listeners.
Yeah, no, absolutely, and I appreciate the compliment on the speaking engagement. As you said in the intro, I'm the Chief Investment Officer at RFG. So that really encompasses, I like to say, three different things. First and foremost, I'm here to serve as an investment resource for every advisor on our platform. We have about 100 advisors spread throughout the country, just north of $4 billion in assets under management in total, about 27 offices across about 17 states. And for every one of those, investment advisors, if they have a question about the market or they have a question about a particular fund or a manager or a particular stock, or, they want to understand how bonds are working, or at least what my opinion of that is. I'm here to serve as that resource and really provide a sounding board for those advisors as they think about how we're managing money for our clients. The second role is really to serve as that same resource for every client that's on our platform. So not just the advisors, but the end clients. We do a lot of work or try and do as much work as we can on educating folks about how markets work and maybe how we think about approaching them, and really kind of just educate and provide answers to the clients so that they can make informed decisions, but also so that they can feel good about the way markets are moving or how they're invested, kind of inspire a little bit of that confidence. And then last but not least, we actually manage a non-trivial amount of assets on behalf of our advisors and their clients, should our advisors choose to use us. So I oversee a team of investment professionals that manage money on behalf of clients. We manage right at just north of $1.3 billion in overall client assets. That's ultimately at the discretion of the client and the advisor, whether or not they choose to use our services or not. But, we are certainly happy for the folks that do and appreciate the trust that they put in us on a daily basis.
Well, and I think that brings up like two good questions. First of all is, do you want to speak to your team and how your team is built?
Yeah, absolutely. We like to, and I think you're going to maybe touch on this later. We like to think of ourselves as an institutional asset manager, and indeed, I think we are. And we'll talk a little bit about what the difference is between that and retail. But just so we're clear, the investment team has sort of three direct people on it. Myself, our head of trading, as well as an adjunct that kind of trades and helps me a little bit on the investment research side. And then in addition to those three people that literally this is 100% of their jobs every day, we have an investment committee that is broadly comprised of about 8 individuals who every time we are looking to make a trade, buy or sell a particular security, rotate a security, do anything else like that, we actually run the investment decision through that committee. So it's not just what I think, it's actually what the consensus of the 8 individuals that are on that team. And then away from that, we also have an investment advisory board that I get held, accountable to 3 times a year, that are comprised of individuals that look like myself at other firms. So all that information is available on our website. You can see, who those individuals are, and what their backgrounds are. But basically about 3 times a year, I get drug in front of the coals to talk a little bit about what we've done year to date and what we're planning on doing going forward. And really all of that, I think, kind of distinguishes us from some of what you find elsewhere in retail wealth management, which is, maybe it's one individual, maybe 2, that are selecting investments as one of the things that they do, but not the only thing that they do. So, they also have a focus on planning, or they also have a focus on, estate planning, or they also have a focus on tax, and they're really, wearing this sort of jack of all trades type hat. We prefer to think of ourselves as, you've got numerous people that every day come into the office thinking about asset management and how do we, maximize the sort of risk return trade-off for our clients. And that's what we really think of when we think of a team.
Would you say that that's the primary difference between when somebody says institutional versus retail, or would you go a little bit more on that? Because I find myself explaining, that we do the institutional investment management, and I see a lot of deer in the headlight, blank statements, or oh yeah, I think that's what everybody does, So how would you explain that?
Look, I think it starts with what we just talked about, right? Which is, do you have dedicated people that this is all they do? It's not a side job for them. It is 100% their pure focus. Do those individuals have oversight in that role and function from other individuals that aren't even necessarily aligned with their core job function? So whether that's an investment committee structure, whether that's a policy board structure, whether these are things that are sort of checks and balances within the system to say, hey, when you're making an investment decision, how did you arrive at that decision? And I'll just be honest, right? You've occasionally run into in retail wealth management, folks that aren't really that rigorous in their decision-making or frameworks and processes. And we sort of think about the institutional side as being more focused on that rigorous approach to this is how we make decisions. We follow a process, which not only us that are held accountable to our investors, but it's also us held accountable to other individuals outside the firm that are kind of maintaining that check and balance. And I really, look, I'm a mathematician, by heart. And when you're a mathematician, you test at kind of the extremes. When I think about institutional asset management, I generally think about highly educated, highly trained individuals that are purely focused on security selection, following rigorous processes, to kind of come up with those, these are professionals, right?
Right.
And when I think about more retail wealth management, you think about the guy or a gal who, they have lunch with a wholesaler who's a representative of a mutual fund company. And the wholesaler gives them a pitch around a particular mutual fund or whatever else it is that they might be hawking that day. And the advisor goes back to his office or her office and, puts in a ticket for a couple of those mutual funds, because they learned something at lunch and they also got a free lunch. So, we kind of want to distinguish between what we do, which is very much, metric and process driven, versus what can be a little bit more, in the worst cases, a little bit more of a hodgepodge approach to how investment portfolios are actually constructed.
Right on. When we talk about the professional and the education that kind of puts you in the chair, do you want to speak to what you did before you were a chief investment officer and what your schooling looked like?
I will. I will first give the disclaimer, which is I'm not a jerk. It's very hard to go through a bio, your own bio, and kind of not sound a little bit like one. But here goes. I had my undergraduate degree from Harvard in applied mathematics and economics. After that, I spent 3 years at this little shop called Bain Capital Credit. Bain Capital Credit was a very small firm. When I joined, they had about 300 million in assets under management at the time, and about 20 investment professionals. So, and I was in a class of 6 when I was hired. So depending on how you want to define it, I was either employee number 14 or employee number 20, somewhere in that range. I was there for 3 years, and then they sent me off to Stanford to get my MBA. When I graduated out of the MBA program, I was the #1 student in the class, so I won the Henry Ford Scholar, and Bain subsequently brought me back after that. And I worked there for the next better part of a decade. And by the time I left, I was the head of consumer fixed income investing, as well as an assistant portfolio manager for our $8 billion CLO portfolio. So this is, and I say this not to, like pound my chest, right? Like, whatever. But I do say that when we hire folks and we look at constructing an institutional investment team, they are folks that look like this. They are individuals that have been investing for decades, highly skilled, highly trained individuals that kind of know the markets inside and out. Versus what I'll call more retail wealth management, which tends to be, somebody who may have gotten, maybe they got their CFA, maybe they didn't, but they are wearing this hat in addition to all of the other things that go into being a financial advisor.
Yeah, and I find myself trying to explain like how that relates and like how you help me help my people, and it just is such a liberating experience that I can rely on your summation instead of me trying to duplicate like what you do, which I've tried in the past, and just it's so much better for me to be able to like lean on your team. So I've just found that it's a tremendously liberating experience over the last few years. And then so the Bluemonte system that you use, when and how and why did you create that?
Yep. So I joined, we'll give everybody a little bit of a history lesson. I joined RFG back in 2016. And at the time was kind of just given a blank slate for whatever we wanted the investment platform to look like. Hey, let's go, let's run with it. And the idea of, institutional investment management is to really provide customization for clients and tailored portfolios for clients, while at the same time maintaining the ability to be able to do it at scale. Because one of the things that I think is really powerful about the investment management side is, if done correctly, it takes the same amount of time and work to manage, $100 million of assets as it does to manage $3 billion in assets. You are really, if you can define the universe of portfolios in such a way to say, okay, look, I have portfolios that are appropriate for a certain amount of risk, and maybe that's, a very conservative portfolio, or maybe that's a very aggressive portfolio. I also have portfolios that are appropriate for different need states in terms of, do I want a lot of income to come out of the portfolio, or am I purely focused on growth? I don't want to see, interest and dividends coming out of the portfolio. If you can kind of define the universe in those ways and offer up choices along those spectrums, right? How much risk do I want to take, but also how much income do I want to be sourcing out of the portfolio? Then you can really offer clients a broad selection of potential options to choose from. I think we offer somewhere in the 30s of total invest. Actually, I think it's north of that if you wanted to get super custom with what you can actually do with the portfolios.
Whether blending or using other things along with it. And yeah,
exactly. Blending if you want muni exposure, or if you don't, or this and that and the other. But so making a long story short, there's north of 60, 70, 80 different portfolios that you can choose that we all manage. However, we've constructed them in a way where certain choices that we make as asset managers in terms of what fund I want to own for international exposure or what fund I want to own for oil and gas exposure flow through to all of the portfolios in a programmatic, systematic way. And so it really enables you as the advisor and ultimately the end client to be like, yep, you know what? Like, I want to take a moderate amount of risk, but I really want to be balanced between growth and income. That portfolio right there on the menu looks good for me. It's like, okay, great. You can pick that. We can do it in a systematic way, and then we can manage it in a way that's not overly burdensome versus what we would be doing for the rest of the clients that are out there in the universe. And it really is that customization, that ability to tailor a portfolio to a client need while also, able to manage assets at scale, that I think is really the magical thing about what we built at Bluemonte.
Well, and then you talk about, so, hey, maybe I want this exposure or that exposure. So when something happens with like a news cycle, like, hey, this is going on with Ukraine, or this is going on with interest rates, or this is what's going on inflation. When you see these like macroeconomic events that get thrown down our clients' throats. So what do you do for your own information cycle, and how does that affect how you invest money?
Yep, absolutely. As you'd expect, this is all we do all day, every day. So we spend quite a lot of time focused on what's going on out there. And the interesting thing is, a lot of it's just noise, right? If you think about the dominant macroeconomic topic that we have been talking about now for over a year, it's been inflation and interest rates, and that's about it, right? Have interest rates gone up too far? Are we, going to kill off? Are we inevitably going to hit a recession, or are we not? What does all that mean? Is inflation getting under control? Is it not? And it sounds like it's new news every time you hear it. But the reality is, we were talking about inflation in late 21, and then talking about the Fed getting involved in May of 22. And now here we sit in July of 23, and we're talking about whether or not the Fed still has 50 basis points or 0.5% of rate tightening to be done before they're done with the tightening cycle. It's kind of a slow news feed.
Yeah.
And so
on a daily basis.
On a daily basis. And so what we try and do, what you're always trying to do is separate a little bit the wheat from the chaff, if you will. What is important, what needs to be reacted to and traded on, and what is just noise. Because if you wind up chasing noise, you normally, the studies pretty consistently show that the more actively you manage these things, the less likely you are to do well. And so, what the first thing that we always do is we get information is this information actually valuable and relevant and useful? Is it impactful, or is it not? And I think usually we're trying to apply a longer term lens to that. So is this something that we're going to face? Is it a 1 month deal, or is it a 12, 18, 24 month deal? And if it's the latter, then that's something that we probably need to address. So things like changes in the interest rate cycle, things like, recession, non-recession, economy heating up, economy slowing down, things like, distributive, as we think about creating portfolios. How does the U.S. economy look versus, Western Europe or Japan or China or emerging markets? So these types of longer term pathways that we really start to think about are places where we're focused on making gradual course corrections over time to try and improve that risk return balance that we were talking about earlier, just try and optimize as we go. And then, I bring it back to those longer term stories are exactly that. They take a while to play out, months, sometimes years. We tried to not be, tipping our, falling over, trying to chase our own tails on, what's this month's unemployment number going to look like? Because you actually wind up doing a non-trivial amount of harm to portfolios when you try and chase it that way. So a lot of what we do in response to that is just try and educate people on why, some of those macro data points that come out more frequently are this kind of like staccato drum beat that's going along in the song. And the more important thing to pay attention to in the song is the actual melody, not each and every beat that the drummer is tapping.
So investing with the mathematician heart as opposed to like emotionally knee jerking at every news cycle is a better way to go.
Just generally, yes. The more emotionally involved that you get, actually, and the studies on this are quite clear. The more emotionally involved you are with the decision, the less likely it is to be a rational one. We are irrational creatures that live in frequently a very rational world. And we don't have to get into all the sort of behavioral economics and, science around.
That'd be a good next episode.
Yeah, it'd be a great next episode because I love this stuff. And it actually is one of the highest value adds of a financial advisor.
Absolutely.
Is coaching people around their emotions and around, making the right decision. But the less emotionally involved you can get, it actually, even as simple as, other people are likely to make better decisions with your money than you are because it's yours. And once it's your money, you feel the sting of gain and loss, whereas if it's somebody else's money, you're more rational in the risks that you take for gains and losses, because it's not yours. You're
one step from the fear and euphoria.
Just that one step away helps a lot. So a lot of times when we get confronted with macroeconomic data, I know, those of us some of your clients probably see our YouTube channel. They know, the constant drumbeat of this is what's going on out there, but this is why you really shouldn't be all that worried about it. We are keeping an eye on things, but the right answer most of the time is to absolutely do nothing.
Fantastic. So that being said, are there certain things in the markets or in the news cycle that you're paying attention to, particularly right now, headwind, tailwind wise, as far as like markets are concerned?
Absolutely. Look, we'll bring it right back to the debate that we've been having now for the better part of 24 months, which is inflation and interest rates, right? The Fed has indicated that they are very close to the end of their tightening cycle, although probably not all the way there yet. Mm-hmm. And inflation seems to be gradually getting under control. And I'll use the phrase gradually getting under control. Okay. We're not there yet. I like to use the example of my 16-year-old daughter, who has just been a joy, all through school, and always bringing home A's and B's in all advanced courses. And then, I think midway through the fall this year, she came home with a D, like a solid D, not a D on an assignment, like a solid, like D for the class. And, so I did what any, helicopter parent would do, which I try not to be a helicopter parent, but, and we got the tutor and we were grounded, studying, and we were doing all of these things. And, probably a couple weeks later, she came in and she's like, Dad, like, I'm so excited. Like my grade's up to a C. Right.
Right.
And I'm like,
framing.
that's great, right? Like we have made progress in the right direction, and that is absolutely fantastic. But the battle is not over, right? we are not done with this task. If we wanted to give a military example, like we can see the beach, but we're not on the beach yet. Like the battle is not won. I think the same thing is true of inflation. We were recording on a month over month basis, kind of 0.5, 0.6% month over month inflation. Those numbers have since come down to maybe 0.4, 0.3, which is movement in the right direction. That's great. But
we're
really
not on the beach yet.
No, not on the beach yet. We really need to be at more like 0.1, 0.2 before I think the Fed will have declared victory here. And to be clear, they're not going to stop until they declare victory. Nobody wants to be known as the Fed that failed to control inflation, right? In the fraternity room where all the Fed presidents go to kind of hang out after work and everything. You don't want to be that guy, right? Like they all make fun of that guy. He sits over in the corner.
Last in the buffet line. Yeah, I'm picturing
Yeah, exactly. Everybody nervously looks away. No Fed president
club.
Exactly. There you go. It's very exclusive. But nobody wants to be known as that guy. So they are not going to stop until it's under control. And we've probably still got candidly a couple more months before the Fed would acknowledge that something, that we've gotten to the point where they're comfortable maybe easing a little bit. In the meantime, we will continue to see news cycles that kind of vacillate between, is the economy too strong and thus maybe the Fed needs more than 0.5%, or maybe these interest rates need to stay higher for longer, which is bad for valuations. And then we'll start to get some negative reports on employment, or, maybe some companies laying some people off, or maybe there's a little bit of a weak earnings season or something else like that. And all of the talk of, have we gone too far and are we about to get a recession, and all of that type of stuff will come right back up again. And so I think until we see it in the data, we won't know. The other thing that I will just mention is we are definitely right now in the Goldilocks phase of this news cycle, where a lot of people have come around to the view of maybe we have gotten inflation under control without having to have a recession. Maybe we are going to navigate our way through this thing. And maybe that means that, companies can continue to kind of earn at the level they're earning now. And then, 6 months from now, 12 months from now, the Fed can go back to a more neutral policy rate. And that means lower interest rates and higher prices for assets. And so maybe we are on the sort of, path just right, or temperature just right path. And I will just say this, I think the other headwind that we're kind of keeping an eye on is, stocks are relatively expensive versus certainly where they were, 5 months ago. Even on a multiples basis, earnings of the S&P 500 hasn't really changed all that much in terms of where estimates are. Valuations have changed a lot. That means that multiples have changed a lot. And so I think that, that's one of the others, just sort of, headwinds, tailwinds, that's out there. There's some good news priced into the market right now. And we'll see if that comes to fruition. It's always concerning. People like to talk about it because nobody likes to buy stuff when it's expensive. But I would just say that historically, price to earnings ratios have never been an actual good indicator of when to buy or when to sell, taken solely on their own. Every model out there that, attempts to build this, well, you should buy it when it's here and then sell it when it's there, and I've found the mathematical answer, normally has some type of added variable on top of it, which helps people fit data, which is a bad thing if you're a statistician.
Absolutely. Well, let's change how we measure it and then think that we're doing okay.
Yes, exactly. I used to joke, people would come to me with, I figured out this quantitative model of like how to trade. And I'm like, well, here's the problem with that is like, I can construct a model that says, every time you buy a stock where they report earnings on a Tuesday and the CEO lives in Pennsylvania, that historically those stocks have had fantastic returns, right? And that doesn't mean anything. It just happens to be a pattern that fits the historical data. It doesn't mean that it has any predictive power. And so, there are a lot of folks out there that, attempt to find the answer, and we call that data fitting in statistics. And it's bad, so don't do it. And if you find somebody that's doing it, run screaming in the other direction, because yeah.
Oh man, I am so glad that I've got you in the system, and I so super appreciate you taking the time today. This has been just great.
Anytime at all. And I appreciate you guys. Thank you guys for reaching out. And who knows? I'm a guest now. I'm angling for the repeat guest title at some point in the future. So you guys just let me know. And
I'm scribbling down a behavioral economics for dummies podcast episode. And so if you're in, that'd be great.
Always.
Go from repeat to recurring role. That sound.
I love it. It.
Okay, so it sounds like that those fancy degrees are really paying off for you. So where can people go to find out a little more information, Rick?
Yeah, absolutely. They can always find Mr. Heckman, and Mr. Heckman always links back to me. You can also go to Bluemonte.com, which is BLUEMONTE. And if you're ever interested and want to buy me a cocktail, I'll explain to you how you have to trademark names in this industry. Otherwise, you can't use them. And when you're trying to find a name that you can trademark, you wind up with odd spellings. So once again, that's Bluemonte, BLUEMONTE. .com. You can look for us and you'll find us on the web, and you can link to my YouTube channel if you like this type of content. You can always find us online and get regular updates that way.
All right, Mike, what is all of this stuff? Where can everybody find you?
Yes, absolutely. So sablepointwealthmanagement.com, spelled SABLE. And then they can call the office, and the team's happy to help at 231-425-4308. That's 231-425-4308. And now the wealthdoc.com landing page is active, so that's a good way to find us too. And re-listen to this or subscribe and join us.
Sounds good. Well, thank you for joining us today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.